Okay, good morning, everyone. We're going to get started here in just a minute. We were having a little technical difficulties, but we will get started in just a moment. Those numbers keep ticking up. Okay. I think everyone that was in the waiting room is in, so we're going to get started. Good morning. Welcome to our webinar entitled Navigating New GASB Standards. We just have a few things before we get going. My name is Larissa Morozic, and I work with Bonnie and Andy here at ABDO. So I'm just going to go through a few housekeeping items, and then we'll get started. All right. If you have any questions during the session, please make sure and put those in the Q&A session or Q&A box below. We will try to get to as many of those questions as we can. If you're having any technical issues, you can go ahead and put those in the chat. That chat function should be right at the bottom of your screen there. And then, as always, we will be sending out this recording after, along with the slides. And we also send out that survey for any feedback, which really helps us plan our next upcoming sessions. So with that, I'm going to hand it over to Andy Berg, who is the leader of our government segment here at ABDO.
All right. Thank you, Larissa. Like Larissa mentioned, we're going to be talking about GASB standards, and the main one we're going to be talking about vacation and PTO, which everyone likes. So I know that's why you all attended. So maybe in the chat feature to get this going and to help everyone else on the call, type in your chat in your favorite vacation or PTO, or if you don't like that, chat in that too. Let's see who's out there willing to share and get that chat going.
I love that, Andy.
I'm not seeing any chats come in, so if you can do that, that's great, and I'll introduce Bonnie as we do that. So like I mentioned, she's going to cover that GASB 101 is the biggest part of it, compensated absences. You probably all have heard about that over the past year, but now is really the time to take a look at it. Bonnie's been with ABDO for over 10 years now, works 100% with local governments, does many different types of speaking engagements, so she'll do a really good job today. Welcome, Bonnie, and thank you for the presentation.
All right, great. Thank you so much, Andy. And I'll share my favorite time to take a vacation is in June, because it's around my birthday, and I would just go anywhere, and anything that I do over my birthday is the very best thing ever. So that's my favorite. All right, so welcome to our GASB webinar. We are going to be touching on the upcoming standards with a focus on the compensated absences, like Andy mentioned. We're also going to go over a little bit of information on GASB 100, which is about accounting changes and error corrections. Just very briefly, we're going to touch on that one. And then a little bit of bonus info for everybody. One very quick reminder on ARPA obligations that we'll touch on. Okay, so kicking it off, what is coming up just in general? What do you need to be thinking about for the next few years? GASB 100 is effective for December 2024 audits, but if you are June 30th, 2024 year end, hopefully you are implementing this right now, or you already did if you had your audit completed. So GASB 100 is really something to think about now. And then our main focus for today, GASB 101, compensated absences. We'll talk about that one in depth. Two that are coming up that we are not going to spend any time on today, but I want to just give a quick update that they are coming, is GASB 102, which is certain risk disclosures. Not too much impact here, but coming up for those fiscal year ends ending after or beginning after June 15th, 2024. So if you're June 30th, 2025 or December 31st, 2025, start thinking about that. And then GASB 103, financial reporting, model improvements is coming up for 2026 year ends. And GASB 103, I've read through it once so far, and if anybody had been following this one for the last few years, it got really scaled back. It sounded really scary at first, but now it doesn't seem too bad. There's going to be some more significant changes with it to the financial statements, but not quite as many as we were worried about. So not too bad there. Overall, when I look at this, I have a little bit of a easier time wrapping my head around these ones than I did around the ones the last few years. I think we have some easier stuff coming up over the next 3 years than we did with leases and SPIDAs, and so a little bit of a breather as we go into these ones and kind of conquer the compensated absences one this year. So we can do it. We can make it through a few more years of these GASB standards. They won't be too bad. All right, so we're going to start with going over GASB 100, which is accounting changes and error corrections. The main reason why we wanted to touch on this one today is because you are going to see some changes within your financial statements. And if you draft your own financial statements, you'll have to know how to make those changes. If your auditors or someone else drafts your financial statements for you, you might not have to think about this one too much, but it's really good to know as you're reviewing, when you review your financial statements, kind of what to look for with these changes. Not a huge deal, but just something that you need to be aware of here. And so this one's really covering anything that it is defined as an accounting change, accounting principle changes, changes in estimates, reporting entity changes, and then also those correction of errors. So a little bit of detail on what this really covers. So changes in accounting principle. So the compensated absence standard, if you have any restatements there, if you have anything where you're switching from one GASB or redefining what GASB standard you're applying to a measurement of a balance sheet item, you're going to have change in accounting principle. This does require a restatement of that beginning, that position. I'll show you an example of what that looks like. This also clarifies what a change in accounting estimate is. Change in accounting estimate, you don't need to restate though, you just need a note disclosure for that one. And then also the error corrections, pretty self-explanatory there what those are, and this would require a restatement. We'll take a look at that. Kind of the big thing to watch out for when you're going through your financial statements this year is this changes to or within the reporting entity. So this is a really interesting one where the standard is clarifying what do you do when stuff moves around within your financials? What do you do with changes in component units? For example, if you add or change a blended to discrete component unit, how do you incorporate and report that within equity? It would not apply to a couple of things that fall within Statement 69, like acquisitions, mergers, transfers of operations, also majority equity interest. It would not apply to those things. So a couple of key takeaways here. A financial statement change, unlike the things we talked about on the previous slide, I'm just going to flip back real quick. So change in accounting principle, error corrections equal restatement. Reporting entity changes, some new language here, not restatement, but if there's a change within those, we're calling it an adjustment. So I'll show you that wording in an example here coming up. So the change you're going to see there is adjustment wording. And then we also have a major change in how major and non-major fund movements are handled. And you're going to include something that's being referred to as a ghost column. And this is only going to show up on the income statement or the revenue and expenditure statements and schedules. And so when you move a fund from major to non-major or non-major to major, which happens often, you are going to have to include a ghost column. And I'll show you what that looks like. It's kind of confusing here. All right, so just before we get into a couple of examples of this, and I'll show you that ghost column, I just wanted to highlight a couple of things as you're applying this standard. So one, what does this really impact? So this really impacts any times that you have to go back in time and make an adjustment to the prior year or change how things are presented within the financial statements. It kind of changes your disclosures as well. The note disclosure remains relatively the same. There's just some clarification on the wording that has to be included. We're really getting rid of this prior period adjustment wording and remodifying the restatement type wording. So it's changing the current practice is you either have a prior period adjustment or restatement to the beginning net position or fund balance. So that wording is really changing, and how you're presenting it within the financials is a big change with this standard. The accounting, the debits and credits are pretty much the same. Nothing's really changing with what you do within the accounting system. This is really a presentation only and reporting standard. So a couple key takeaways. New accounting standards and error corrections are restatements, reporting entity changes are adjustments, and then the note disclosures are just being clarified a little bit there. Okay, so let's look at a couple of examples for what this looks like. Now, these examples are from the Government Finance Officers Association. You go out to their website, you can find this super comprehensive Excel document that it includes so much good information. I really love it. And so if you draft your own financial statements and you're like, oh, I just cannot wrap my head around how this needs to be presented or what this wording needs to be, you can go out to their website and you can grab this Excel document that will give you an example for each item. Here's just a quick screenshot of a couple of things. So you can see here the wording on the bottom. We have the fund balance section. So this is focusing on the governmental funds. So we have the fund balance section, and the one that is really going to be the most impactful this year is when you have those major to non-major or non-major to major fund switches. And so the wording that will be included is change within financial reporting entity. And then you can either disclose this much detail in the notes, or you can put it right on the face of the financial statements. You can see here it says major to non-major funds. So you're describing what is that reporting entity change. And what they want you to do is they want you to say, okay, as previously presented, so on last year's audited financial statements, we had this much in fund balance. If we have this formally major fund, you can see how it's all empty except for the fund balance. And we're doing an adjustment to back out that 2.5 million to say, okay, if this hadn't have been major last year, really our beginning fund balance would have been 0. And so the goal is that you always have a line item for your beginning fund balance that will tie out exactly to last year's audited financial statements. So it's kind of nice. As an auditor, I like to tie things out, so that's nice. It looks weird, but so you're going to have this blank column in here. Now, if we go to the non-major governmental funds, we can see here's that same 2.5 million changes within the financial reporting entity. So you can see the same fund here, private grants fund. This was a major fund last year. It's a non-major fund this year. So we have 0 in the fund balances as previously reported. And then you can see that adjustment to bring in that beginning fund balance. And so this total all ties out very nicely. Keep that in mind when you're going through and deciding what your major and non-major funds are. Let's say you maybe have a community center or something that switches back and forth often. Talk to your auditors about maybe is there a good reason why that fund is significant enough to the entity where if it's really close to being major versus non-major, does it have a significant role to play within the government where it would make sense to keep that as a major fund when it gets really close to that mark? So it's not too hard to move these things around, but with this new standard, it would be a really good time to evaluate some of your funds that might switch back and forth and think about if you want to keep one as major going forward, even if it doesn't quite meet some of the criteria. All right, so that's the fun part with GASB 100. I wish there was more to talk about this because now we get to go into GASB 101, which is not as much fun, but still kind of fun. It's not too bad. Again, it's not leases. I'd rather talk about this than leases or CETA, so this is good. All right, so GASB 101, we're going to talk about vacation, sick time, other types of leave that we have to consider now. And what I really want to get out of this conversation today is, okay, we know what a leave balance is. That's not that hard. We can look at our policy and we can say, yep, we offer vacation, sick time, ESST, other types of leave. We offer all of these things. Now, how do we get that onto our work paper? What does this look like when we actually need to bring it into our liability? Because that's the part that's really, really changing, is how much sick time do we bring into our liability? How much vacation do we bring in, and how do we evaluate that? So let's get down to that. We'll end our conversation today with an example, and we'll run through a work paper. Just at a very basic level, here's the definition of a compensated absences. And again, I just want to reiterate that this is effective for periods beginning after December 15th, 2023. So December 31st, 2024, those are the first entities with fiscal years December 31st, 2024 that have to implement. And then if you are a June 30th, 2025, that's when you'd be looking at this for the first time. So compensated absences is a leave for which employees may receive cash payments when the leave is used for time off, other cash payments, or non-cash settlements as well if you do a conversion to any type of post-employment benefit besides pension. Okay. All right, so break that down a little bit further. Here are the 3 questions to ask yourself. What leave balances are you going to include? If all of the following are true, that means that it qualifies as a compensated absences, besides some exceptions, of course. So number 1, does that leave accrue from services already performed? So did the employee do something, work their job to earn that leave? So that's question number 1. That's pretty easy to answer. Usually yes. And number 2, does the leave accumulate? So is it a use it or lose it type leave? Or do they get to carry that over in some capacity? So that's question number 2. And then number 3, is it more likely than not to be used or paid out? So this, I've bolded it and italicized this one because this is where it gets to be a little bit different than the current standard. We really got to think about not just paid out, not just when they leave our employment, are they going to get a check for leave that they earned and that they can have paid out to them, but are they going to use any of this leave over the course of their tenure? And then we also have to consider used leave balances that have yet to be paid out, but that's something that we already do. Nothing new there. And what I'm talking about on that last one is if they had used any leave, in that last pay period before the first pay period of the next year, we got to include that in our accrued wages. So a couple common examples. And again, this is the easy part of the standard. Common examples, we know what a leave balance is. Vacation, sick time, PTO, sabbatical leave. I keep asking cities, do you have any sabbatical leave? Is that a thing that exists at your city? Because I thought that was a really interesting example. And I haven't heard anyone say yes yet. So throw it in the chat if you have any sabbatical leave. I would love to hear if you do or not. I'm just really curious to how many of that applies. And then if you are in a state that has some safe and sick time requirements, that is something that you do need to consider. So this is really all encompassing. This really encompasses all leave that you might have, and you need to apply those first 3 questions to any of these leave balances. Okay, and then there is also floating holidays is another example that I don't think we often consider, but we do need to consider under the new compensated absences requirements. So what is not included? So if the leave affects only a small proportion of your employees and it's relatively sporadic in its use, you do not need to recognize it under compensated absences. Also, leave that will be settled through conversion to like a pension plan should also not be recognized in there, or OPEB that's already considered within GASB 75, GASB 68, OPEB, and pension consideration. Okay. So how do we calculate this liability? So there is the stuff that we've already been including, all of the leave that will be paid out at termination. So within your employee policy, your employee handbook, personnel policies, it says in there, how much can the employee receive when they leave employment, either through retirement or termination or whatever. And right now, the practice is that, that's what we're going to accrue. We're going to accrue the leave that we know we owe the employee when they leave service. And so that's not too hard. It's usually like 50% of the sick time, or they can have up to, 20 vacation days paid out, something like that. And then there's the next part of it, which is a little bit of a newer concept, where we need to add on the leave that they're going to use during their work. So we need to make sure to include in that compensated absences liability not just that 50% of the sick time that they'll pay out, but what about the other 50% of that sick leave liability that they're carrying? How much of that do we need to accrue? Because certainly they're not going to use maybe all of it, but how do we know how much they are going to use into the future? I don't have a crystal ball, and I would love to hear if anyone else does. I don't think anybody does, but it would be nice. But we need to know, we need to develop some sort of estimate on how much people are going to be using into the future. And we can do that. We can look at some historical trends. We can think a little bit about what our employees have done over the last few years, maybe by department or by union or any other type of classification that we think is reasonable. And one question that I've been hearing on this a lot is, how does GASB expect us to come up with this estimate when it can vary so much from employee to employee? And I think one thing that that's understood is that estimates play a role in so much of what we do within the financial statements. If you think about your OPEB and your pension, depreciation, amortization of the leases, things like that, those are all based on estimates. And now we're bringing this concept of an estimate into the compensated absences liability recognition. And that's okay. And as long as we have some sort of reasonable input that we're putting into the estimate for that future use, that's an okay thing to do, and we can come up with some way to calculate that. And so really what we're going to be doing is just we'll put a little bit more thought into what that use is, and then we'll add that on top of what we know the employee is going to get paid out at termination. Those are going to be our total hours to accrue. And then from there, everything stays pretty much the same. We just have this one new piece that we need to think about, and then we get our total, apply it to our pay rate, and we get our compensated absences balances. All right, so a couple of things to take away. Pay rate. And so the pay rate, that's not changing that much. That is going to be used as you're going to be measuring the liability using the employee's pay rate as of the date of the financial statements. So nothing new there. We'll take that, what their pay rate was as of December 31st. If you know that a leave balance is going to be paid out at a different rate, you are allowed to use that different rate to calculate the liability. And I would love to hear from people if anybody can think of a situation where they know what those future rates are that leave might be paid out. I was trying to think of an example of that, and I really could not think of one that would fit that. So I think 90% of the time what we're going to see is people are going to be using that December 31st approved pay rate. So pretty much the same thing you were doing there. And another thing I wanted to mention, no big change, but just something to remember, modified versus full accrual. So leave that is paid out shortly after year end should be included with salaries payable. So let's say that you have an employee retiring in January, and you know at year end that they're retiring and that they're going to get this really large payout of their vacation and sick time. That is something that instead of including it with the long-term compensated absences or even on the short-term compensated absences just in the government-wide, if they're a governmental fund employee, you're going to include that in the modified fund statements. So in your general fund, you're going to have a compensated absences balance. One more thing that I'll mention on that, and this happens very rarely, but every once in a while, we do run into a city where they report all of their compensated absences within their general fund and not just the payments that are expected to be paid out shortly after year end. And so something to think about as you're implementing GASB 101 is, where do we report our compensated absences? This is a good time to evaluate what you have been doing just overall for compensated absences and make any changes that are needed. So if you don't have an employee that you know their leave is going to be paid out shortly after year end, those balances should really be reported in the proprietary fund, full accrual financial statements, or just on the government-wide. Keep those compensated absences liabilities out of the general fund. So again, the big change that we're looking at is the evaluation of the balances that may be used while the employee is still working, and not just what is eligible to be paid out at termination. And this will be, I don't want to downplay this at all, because this will be a big change to your work papers. There are, I looked at a few of our audit work papers that we get from the cities that we work with, and there are so many of them that are set up so specifically to say, okay, here's, the total leave balance that they have, and then apply these series of calculations to say, all right, they've been here 15 years, so they get 20% on payout, and or they've been here 10 years, and so they get 10% on payout. So a lot of that is going to be going away, and I think it's a great opportunity to really streamline your compensated absences work papers and reach out to because those calculations can be so messy and so intense. I'm going to show you an example, but really reach out to your auditor and say, hey, how can we rework this so that it meets the new standard? If you're going through it and it's like, oh, I just don't know what to take out or leave in, reach out to your auditor and get a good understanding of, okay, how can we make this work paper, kind of fit with what we need to do now and make it just easier in general. And I personally would love to help you add in just a ton of sum if formulas. That's my favorite thing to do to compensate absences formulas, is get rid of all of the individual sums and just add in a bunch of sum ifs. So reach out to me directly, please, and we can have a lot of fun reworking your compensated absences.
Hey, Bonnie, there's a couple questions in there. I don't know if you can see the
Oh,
Q&A that
perfect.
maybe you want to take a look at and good time to answer.
Yes, that's wonderful. Okay, so let's see. I think someone was wondering if we are going to be sending out the slides, and yes, we are
Probably
going to
check
be.
on the open ones versus the answered. So one's about what about comp time, and then
Thank
potentially
you
using
very
the
much.
COLA rate for next year.
I know how to use Zoom Q&A now. Thank you, Andy. Learn something new every day. Okay, so yeah, so what about comp time? Yep, so comp time would need to be evaluated just like any other leave. So we'll walk through some of those criteria. And then COLA rate for next year. Okay, so that's a really good question. And we do not want to apply the pay rate. We want to use it as of the financial statement date unless we know that next one. So what I would say about the COLA rate for next year is you don't really know that all of that leave balance is going to be paid in the next year. It could be paid in the next year after that, or the next year after that. That's a little bit too uncertain for me. If you expect that a certain amount of sick time is going to be paid out within that next year, you could use that COLA rate if you wanted to. I don't think it's specific enough. And so what I've seen is that you apply the employee's pay rate as of the date of the financial statements to this estimate, and we'll walk through that. And then another question just came in. We have a sick leave bank. How do you record that? Again, historical data of when or how much it's been used. So yes, we will go through an example of how that is calculated. And if my example does not cover that question clearly enough, re-ask that and we will go into that again. Okay, so I just wanted to make a quick note on note disclosure changes. So the note disclosures are relatively unchanged except in the long-term liability footnote. You don't have to present an increase and a decrease. You can just do a net amount, which is my favorite thing in the entire world. So that's really amazing. You just have to disclose that it is a net amount. And then you also don't need to say which fund is intended to liquidate the compensated absences liability. So I believe it's somewhere in note 1. It usually says what fund is intended to liquidate the compensated absences liability, and you do not need to say that anymore. So a couple of nice, easy changes there for note disclosures. Okay, so just a little bit of an overview of implementation. So number 1, review your policy. Number 2, pull some historical use reports so that you could see what people have previously used. And number 3, calculate the liability. And these historical use reports, what I mean by that is pull a report, and you probably have it from your past work papers, but gather the data that says in 2023, these people used this much of their vacation, they used this much of their sick, and pull that for the last couple of years. I'll show you kind of how to summarize that information. And then you're going to use that as one way that you can use that to calculate how much they are expected to use in the future of their balance. We have another question that came in It says, if we have unsettled negotiations, do we assume the last approved contract for reporting purposes? Feels like it would be too much of an estimate to guess the settlement rates for accruals. I totally agree. And yeah, you really need to be certain about these estimates. Or I shouldn't say that, because you can never be certain about an estimate rate, but you need to be reasonably certain about it. You have to have some sort of confidence in it. And so if it's something that feels if it's an unsettled negotiation or something that's like, oh, I just don't know. If you just don't know, then don't include it. It is an estimate on the financial statements, and it will be disclosed as such. Okay, let's go into some examples here. And I have a couple of examples on the PowerPoint here, but I am going to attempt to switch over to an Excel document. So let's see if we've gone through all of our technology snafus for the day and if this can be a seamless transition. And if I could get someone to put in the chat or just do a quick shout out, Andy, if you are still there, can you see my
Looks
Excel?
good.
Okay,
can
thank
see it.
you. All right, awesome. We have conquered our IT challenges for the day. That's perfect. Okay, so when we first started talking about this, we said there was 3 questions that you need to answer. And so I put together a little chart here that helps summarize those 3 questions to decide if it's applicable or not. And you don't have to do something like this. This is not a requirement, but I find that it's really nice to have just like one place where you're listing everything. And as an auditor, you know, I'm gonna ask if, hey, did you look at your policy and evaluate these balances and consider, you know, floating holidays, parental leave, bereavement leave, stuff like that, and if it applies to GASB 101. So nice to have some sort of documentation that you can either go over with your staff or go over with your auditors for how you evaluated these things. So let's run through just a couple of these and how they're evaluated. Okay, so I put down here all the different types of leave balances that I noted in this example city, and for sake of answering one of the questions that came in, let's add comp time. Okay, and we'll leave that one as blank. Okay, so vacation is almost a guarantee, right? First question, is the leave earned from services that were already performed? Yes. Does the leave accumulate? Almost always, yes. I can't think of any vacation that doesn't accumulate. And when we say accumulate, really we mean, does this carry over to the next year? Is the leave likely to be used or paid out? Yes, right? People are going to get that vacation payout. All right, so applicable to GASB 101? Yes. And then I just put a quick note in here that will carry over for the rest of the example. The vacation policy that we're looking at is they can carry out 80 hours of their PTO, or up to 160 hours can be carried over to the next year. And so they don't get all of their vacation paid out, but they can carry it over and use up to 160 hours. And then sick time, same evaluation. In this example, 50% is paid out at termination, up to 480 hours can be carried over to the next year. Now, floating holidays. This one is interesting because I think policies differ on how this is handled. So floating holidays, you do have to work to earn your floating holidays. The question or not is, do they carry over? Do they accumulate? And so they might accumulate, you know, during the year, but as of December 31st, is the employee going to still have that floating holiday bank on January 1st of the next year? And if it does accumulate, then you need to consider it. And so let's say that yes, it does carry over. And then the third question is it likely to be used or paid out? Well, I think everybody's going to use their floating holidays if they get them. And so then if the answer is yes, they are likely to be used, then floating holidays could be subject to the compensated absences. So I think the big one on floating holidays and things like that is, does it carry over? For this example, we're going to continue to say no. Okay, so parental leave and sabbatical leave. So on those two, I said, you know what, those are really sporadic in nature and they don't really apply to everybody. So we're not going to worry about that. So now let's talk about comp time. So comp time is earned, right? And it generally accumulates at the end of the year. It isn't often where you see that it gets paid out, but people use it, like sick time and stuff like that. So it's going to be used. So yes. So yes, comp time would be applicable. So you would need to consider that in there. All right, so next thing that we're going to do is we're going to look at how do you evaluate this use? How do you evaluate, going back to the idea of the sick bank? We have, so much time in a sick bank that people have earned, and it accumulates, and they will use it in the future, but how much of it will they use? So we're going to take a look at that next, and I'll show you this little chart that I've put together. But let's answer a few questions. What's the best practice to determine employees' future use? Evaluate on a per department basis or similar. I love that question so much, and I would highly recommend on a per department basis, because very quickly they are going to become not a new employee, right? And you have to be able to have some sort of trend to apply it to. Another option, if you feel like it's better for your city, is you could look at the time, the use based on service time. And so here I have it based on department. But another option is if you could say, okay, employees with 1 to 5 years of experience, they generally use this much time. 5 to 10 years of experience, they use this much time, and so on. I think that would be more complex. I don't know if the data would be as readily available and as probably isn't necessary, but that's where, deciding for your city, how can I best evaluate how people use their leave? And then what kind of historical data can I pull based on that? Another question that we have is, our comp and vacation are always booked as 100% current, since they get paid out 100% upon termination. Is there any need to look at usage for those? No, that's perfect. You do not need to look at any of the usage. So in one of my examples, I'll kind of run through when people have less than the policy that they would pay out. How would you bring that into the liability? Next question is, do you book the liability based on the amount that can be carried over or based on the paid out amount? That's a really great question. We will look at that in the example. And if I don't answer your question with the next thing that we look at, please let me know. And then if comp time is sporadic, would it still apply? That's a really good question. So I guess how sporadic? If it is truly sporadic and it only applies to a few of your employees, then it would not apply. And what is sporadic? The standard does not define. And so I would suggest seeing, okay, how many does it apply to? If it's less than 25%, that's probably a good measure, but you would have to make that determination. And again, those are great questions and something to definitely consult your auditor on. Okay, the next thing that we're going to go over is this use evaluation spreadsheet. And so thinking about how employees use their sick time, and vacation. I think that department is a really good way to go. The data is readily available, so that's what I'm basing my example on here. And what I've done is I've pulled some historical leave reports that break down the employees, have all the employees on it. It has the department, employee, department, and the used information. This is the information that you need for this evaluation. And also the total. And so we can see what percentage of the balance was used during the year. And then we can see here, okay, what is the average? So I've put it onto percentage of leave used. So we can get an average of, okay, what are people actually taking? How much of that time is actually being taken? And so we've got an average here, and I did it for 3 years. I felt like that was a pretty good amount of time to be evaluating. And you could add more data. I think 3 years is a good minimum, but again, something to consider as you're going through and developing this. So I have an average here by department for both vacation and sick time. A couple things that you want to consider when you're doing this. If you know that your public works director left during one of these years that you're evaluating, and he got paid out a ridiculous amount of hours because he had been there for, 40 years, consider taking that out of your estimate and your average. You can remove those outliers, if you will, to get to a better understanding of the use. Okay, so the next part that I want to walk through is looking at a few different things in the policy. So we're going to focus on vacation and sick time. And depending on your union agreements or your employee handbook, different employees might have different max payouts. And it might also vary by time. And so this might need to change a little bit. But the general concept is on your compensated absences work paper, have a separate spot where you're identifying the payout that can occur and the max amount that can be accrued, along with the estimate of the use. And so you might have something like this already. How much can these people get paid out? So for vacation, it's 80 hours. And I, just to make it really simple for my example, I kept it all at the same department. But you really need a spot where you're identifying all three of these things. How much can get paid out at termination? How much can they accrue just in general and use in the future? What's that max accrual? And then how much of that max accrual do we really think they're going to use on top of the termination there? Okay. So now I'm going to go over to the work paper, and I'm going to show you just a couple of things on here just to give you a feel for how I would suggest doing this calculation. Again, when you're going through your work paper, you're probably going to need to set it up a little bit differently, and I would really recommend reaching out to your auditor. We would love to walk through this with you. All right, so I'm just going to take this employee number 11 and 12. Nope, that's a terrible example. We are going to look at this police officer right up here. So I am going to hide everything else except for him. Apologies for not having this filtered previously. Okay, let's do employee number 2 first. Perfect. All right. So for vacation, on this police officer, he right now has 48 hours of vacation time. And on my work paper, I've identified that he gets, I have a lookup function in here from my little table telling me that he can have a max of 160. He gets 80 when he's done with his service. And based on my historical estimate, he's probably going to use about 32% of his time that he has accrued. And so 32% is 15 hours. Now, I know that you're going to save up as much as you can to get paid out at the end. I think that's a reasonable estimate that this police officer, if he can get paid out 80, he's going to try to get paid out all of that 80 hours, right? And so my calculation here is twofold. One, I have one column that says, okay, what are those hours to be paid out at termination? That's the first thing I'm going to consider. I know people want to get as much money as possible when they leave employment. And so I'm going to take the greater of his possible termination, which is 80. Or I'm sorry, lesser. I'm going to take the lesser of his possible termination, 80, or the total that he has accrued. And so here he only has 48. And so I'm going to put all of those 48 hours into this first bucket. Got his first bucket, which is 48 hours. And that's all that he has. So I don't really need to worry about the use on him. I don't need to really think about, how much he's going to use in the future, because I know he's going to save up all of those hours. So 48 is what I'm going to accrue for him. So kind of like the same calculation. And then on his sick time, he can accrue up to 480. And so he has, he can get paid out 240. So same thing, where he has 212. So he's going to save up all of those hours. Okay, let's go to another example here where someone has a little bit more than what they have on here. So let's go to this firefighter, who for his sick time, he has 1296. Let me get this filtered so we're not looking at a bunch of stuff. Okay, so he has 1,200 hours banked up. His max accrual is 480. He can get paid out 240 of that. And I think that he's probably going to use about 32% of that balance. And so what I've done is I've calculated, okay, so what really is that 32%? So for him, it's the 1,200 times 410. Okay, so let's think about what his accrual should be. Well, I know he can get paid out 240, and so I'm going to put that in this first bucket, where he's going to save up at least 240 of those hours. And now I look at how much I think he's going to use. Well, my use calculation is 410. He can only accrue up to 480. And so if I put in here, how much I think he is going to use, that's way more than the 480 max. And so I'm going to limit this to his max accrual. And so his total accrual hours is going to be that 480. Let's go to just one more person here who's not quite at the max, but is over the termination. One more example. So this person has 391. Max accrual is 480. They'll get 240. So again, I'm going to put 240 into that termination bucket. And then for the use hours, I'm going to put in that 97. So I think they're going to use about 25% based on my estimate. So for them, it's not the max accrual hours. It's not the hours that they have remaining, but it's this 337, which is how much I think they're going to get at termination and how much I think they're going to use on top of that. So 337. Okay, that's all the example that we have time to go for today. And I'm so sorry I'm not leaving more times for questions. We're at 11:57. If you have any questions during the last 3 minutes, please put them into the chat. If I didn't answer any of your questions that you had, please put them into the chat while we still have a couple of minutes left. I did want to do just one quick reminder on the ARPA obligations. And so just a reminder for everybody, if you have remaining ARPA funds, they have to be spent or obligated by December 31st. And to obligate them, it has to be very specific for how you have to go about and do it. So please reach out to your auditors. Okay. All right. So we have one question that came in. If we already book sick because we pay out a portion at termination, would this evaluation just be on the remaining amount we originally don't include in our liability? For example, you say 50%. And can the spreadsheet also be emailed out? Yes, I will include this spreadsheet with the PowerPoint as well. And yeah, and it can just be on the remaining 50%. So you don't have to do the use calculation on the entire balance. It kind of depends on how your termination policy works. That's why everyone's just going to be, it's going to be a little bit different. But yeah, I will send out that spreadsheet. And then if we pay out 100%, then do we not have to do these calculations? You don't have to. Yeah, if you pay at 100%, don't worry about it. It's really just applies to when things are, there's some balances that you haven't been including in your liability that people could use in the future, is where things are just getting a little bit complicated.
So Bonnie, back to that other question, if you're doing your estimated use after the amount paid at termination, that would stand, but you could do your estimate based on a total and then factor what would be paid upon termination too, right? So there's different ways to do the estimation.
Yes. Yep, definitely. There are different ways to do it. So, and kind of think about how your work paper is already set up to do it. And I've run the calculation a couple different ways. It doesn't change the output significantly for, different theories. Last question that we have time for, I think, is sick pay is paid out at 25%, no limit. Would this cause the liability to increase significantly? Yeah, I think it would. Because really you hadn't been including any of the stuff that people used during their service.
Yeah, I think in a lot of cases, we're going to see this compensated absence liability be higher than in previous years.
Yeah. Those are all really great questions. Please reach out to me if anything else comes up.
All right. Thank you, Bonnie. Thank you, everyone, for attending. And again, this recording will be available, and we're always available for questions too. Have a great day and plan a vacation, right? Use up that vacation time.
That's right. All right. Thanks, Andy. Thanks, everybody.
Thank you.